Hello and welcome to the Quorum Forum. My name is Kelly Milligan. I'm a managing partner here at Quorum Private Wealth. We're going to use this channel to talk about current events, financial issues, and wealth management topics that we think you will find interesting. And speaking of interesting, our first topic is interest rates. I'm here with my partner, Mike Barry. Mike is also a managing partner at Quorum Private Wealth. He's been in the financial services industry for 33 years. So Mike, we've been in an interest rate environment now that has been incredibly low for over a decade, but now interest rates are starting to rise. Why are they rising?
Simple, inflation. And we've gotten used to a cycle where inflation was running between 0 to 2% each year, and that's changed, and it's going to be very disruptive.
So how are consumers then going to feel this inflationary interest rate environment that we're in?
They're going to fill in their pocketbooks more than anything, and also depending on how wealthy the individual is, they'll see it through mostly the cost of borrowing. So whether it's your mortgage rate, your car loan, or credit cards, any other type of consumer debt that the person has, they're going to actually feel that in their pocketbook.
So interest rates rising, inflation rising, how are then investors going to experience this in their portfolios?
Well, like I said earlier, it's going to be a little bit disruptive, and it'll be something that will create some changes across the board. So typically our clients own stocks, real estate, or bonds. So if we look at each of those individually, stocks traditionally do fairly well in periods of inflation. Why? Because the economy is booming. It's extremely hot. You're seeing revenues increase. Companies have more pricing power where they can pass along the higher costs on to consumers, and they end up with higher profits generally in the end. So good thing for stocks normally over the course of time. Real estate, and being a hard asset like art and commodities and other things, generally does very well during inflationary and higher interest rate periods too. So if you're invested in real estate, typically the result will be stable prices and probably even inflated prices over time. Bonds are a little bit different animals. Since bonds are usually fixed instruments and very sensitive to interest rate increases, there's quite a bit of turmoil as interest rates rise and a lot of adjustment there. Because of that, you'll end up seeing prices move. But there's a silver lining in that. Because interest rates move up, you're going to be able to see your bonds and bond managers redeploy out into higher yields, which ends up increasing cash flow back to the bondholder. So it's a real benefit. So the challenges during periods of time like this is that even though there's some market turmoil during the onset of inflation and in interest rates increasing, at the end, as long as you're diversified and you stay diversified and keep a long-term view, it actually ends up working out to your advantage over time.
So it sounds like the advice is maintain diversification, keep a long-run view.
Absolutely.
I think that makes sense. So Mike, thank you for joining us. Thank you for joining us at the Quorum Forum, and we'll see you soon.